नमस्कार हमरो सेटिंग सिस्टम रो प्रॉब्लम है तो से करूछन 2 मिनिट रे से रेडी हे तो हमें आकु पढे दवा से समयटा वेस्ट होला से समय आकु पढे दिबा
Good afternoon, friends. Today we will discuss Unit 9 of Financial Management, that is Sources of Finance. Before discussing this unit, let me first tell you what are the objectives of our study today. First, we will discuss, after studying this chapter, you can know different sources of finance. You can also know the importance of different sources of finance, what are the advantages and disadvantages of different sources of finance, and we will know different ways in which an organization can finance its operations. Let me first tell you the structure of our discussion. First, I will give a introduction, then I will give different classification of source of finance, then we will discuss long-term source of finance, next we will discuss short-term source of finance, next we will discuss how financing can be done through different financial institutions, next at last we will discuss different emerging source of finance, and last I will give a summary and keywords for this session, and we will conclude our session with some important question. Now please see, a organization require finance for two purposes. First one is to establish the business, that is to acquire fixed assets or permanent assets of the business. Organization require finance for two purposes. First purpose is for establishing the business, and the second purpose is to run the operations of the business or to run the business. Hence, the financial requirement of the organization differs. It can be finance required for short-term purpose and finance required for long-term purpose. Hence, the financial requirement of an organization can be classified into two parts. One is short-term finance, another is long-term finance. So what is short-term finance? The finance required for less than 1 year is known as short-term finance, and the finance required for more than 1 year, that is known as long-term finance. If you require finance for 1 month, 2 month, 3 month, it will come under short-term finance. But if you require finance for 5 years, 10 years, 15 years, 20 years, that is long-term finance. Generally, the finance required for establishing the business are long-term finance, but the finance required for running the business are short-term finance. There are different sources of short-term finance, there are different sources of long-term finance. Next, we will discuss classification of different source of finance. How different source of finance will be classified? Normally, the source of finance will be classified in three broad categories. One is on the basis of time, another on the basis of ownership, another on the basis of source. Generally, on the basis of time, the finance can be of three types: long-term finance, medium-term finance, and short-term finance. What is short-term finance? Finance required for less than 1 year, that is known as short-term finance. What is medium-term finance? Finance required for more than 1 year, that is more than 1 year but less than 5 years. More than 1 year, less than 5 years. That is medium-term finance. And what is long-term finance? That is finance required for more than 5 years. Finance for more than 5 years. 5 year, 10 year, 15 year, 20 years, those are known as long-term finance. Hence, on the basis of time, source of finance can be classified into three broad categories: long-term finance, short-term finance, and medium-term finance. However, on the basis of ownership, finance can be two types. First is owned finance or own sources, that is own sources. Second one is borrowed sources. What is own sources and what is borrowed sources? Own sources are those source of finance where the person who finance the organization own the organization, that is known as own source of finance. And if the finance is obtained in form of loan, that is known as borrowed finance. Owned finance is known as equity and borrowed finance is known as debt. That means if the finance is obtained in form of debt, that is known as borrowed finance. If the finance is obtained in form of equity, that is known as owned finance. Next, on the basis of generation of funds, finance can be internal finance, that is self-generated finance, and external finance, that is finance obtained outside the organization, that is known as external finance. Next, we will discuss one by one different long-term source of finance. Next, we will discuss different short-term source of finance. We have already discussed what is long-term source of finance. That means the finance which is available for 5 years or more, that is known as long-term finance. 5 years finance, 10 years finance, 20 years finance. We have already discussed these finance are obtained for establishing the business. Okay, these finance are obtained for establishing the business. And we'll discuss different sources of obtaining long-term finance. The first source of obtaining long-term finance is equity capital. What is equity capital? Equity capital क्या है? Equity capital is also known as ownership capital. The company may issue equity shares to raise long-term finance. Equity shares, the capital of the company is divided into smaller and smaller part, and each part is known as a share. The person who buy the share becomes shareholders. Shareholders are the owners of the company. And equity shares is also known as common shares. The equity shareholders are the common shareholders of the organization. The equity capital may be of two types. One is ownership capital, या owner's equity. Another is preference capital. We will discuss preference capital later on. Equity capital is common shareholders capital. The person who buy the common shareholders are known as equity shareholders. The equity shares are perpetual in nature. That means once the shares are issued and fund is obtained, there is no compulsion to return the fund unless and until the business is liquidated. If the shareholder require the fund, they can sell the shares in the secondary market, which we have already discussed in our previous session. That means equity share capital is the real ownership capital of the organization. Equity share capital is the risk capital, is the most risk capital in an organization. Why it is the most risk capital? Because there is no guarantee of getting return. There is no compulsion. The company is not bound to provide a return to equity shareholders. Dividend the company may provide or may not provide to equity shareholders. That is equity share capital. Okay. Now we will discuss different advantages and disadvantages of equity share capital. I have already told that there is no compulsion on the part of the company to provide dividend to the equity shareholders. Similarly, at the time of liquidation of the company, at the time of closure of the company, the First, the outsiders take back their money. Then, if any claim remains, the preference shareholders take back the money. And if anything remains, that will be taken by equity shareholders. Since equity shareholders has a residual claim on the profit as well as assets of the company. Equity shareholders has a residual claim. Next, we will discuss different advantages and disadvantages of equity share capital. I have already told equity shares are not repayable to shareholders. Once fund is obtained from equity shareholders, it's a permanent capital. There is no compulsion to repay the capital to equity shareholders unless until the company is liquidated. However, the buyback of share option is available with the company provided it satisfies certain conditions mentioned in Companies Act 2013. Next, equity shareholders. If a company has more equity shareholders, its debt raising capacity increases. The persons are interested, financial institutions are interested to provide finance to those organizations which are having higher equity percentage in their capital structure, because equity shares provide a buffer to the debenture debt holders. That means if something happens, the first risk is bear by the equity shareholders. If the profit of the company declines, equity shareholder will not get any dividend. If the assets value decreases, though there will be value erosion in equity of the organization. Then the company has no legal obligation to service the equity shareholders by paying certain rate of dividend. The dividend rate of equity shareholder is not fixed. If there is loss, the company will not pay any dividend. And the rate of dividend of the equity shareholder is also not fixed. So this is the advantages of equity shareholders. Next, we will discuss what are the disadvantages of equity shareholders. What are the disadvantages of equity shareholders? The most important disadvantages of equity share is the cost of equity is very high. Cost of equity, that means the expectation of the equity shareholder is high in comparison to preference shares or debenture or bond or debt. That means if you raise equity capital, the cost of capital will be high. This is because the equity shareholders take high risk, the flotation cost is high, and the equity dividend is not a tax deductible item. It is not an expenses, hence it is not a tax deductible item. Therefore, the cost of equity is the high among cost of debt and cost of preference shares. Next, equity shareholders have a residual claim. This is the demerit. Once the claim of debenture holders and preference shareholders are met, then anything remains that goes to equity shareholders. Next, equity shareholders affect the valuation of the company. The valuation of the company, if a company go on increasing more and more equity capital, there will be dilution of earning of the company, which will affect the valuation of the company. So this is equity share capital. Next capital is preference share capital. What is preference shares? Preference shares are also called quasi-equity shares or hybrid shares. Why preference share have known as quasi-equity or hybrid share? Because they have some feature of equity and some feature of debt. They are shareholders. They are owners of the company, but they have two specific features. First feature, equity shareholders take, preference shareholders take fixed rate of dividend. The dividend paid to preference shareholders is fixed and it is paid prior to making payment to equity shareholders. That means if there is profit of the company, first preference shareholders will take back dividend at a fixed rate. If anything remains, the equity shareholder will take. Second features of preference shareholder is at the time of liquidation of the company, at the time of closure of the company, first the assets are sold and first payment will be made to outsiders. Then next payment will be made to preference shareholders before making payment to the equity shareholders. Hence, preference shareholders has two unique features. First feature is they have a priority over profit over equity shareholders, and they have a priority to take back money at the time of liquidation over equity shareholder at the time of liquidation. But there is a important limitation of preference shares, that is preference shares do not have voting right. Next, we will discuss the merits and demerits of preference share. First merit is the dividend is fixed. Then preference share may be cumulative in nature. What is cumulative in nature? In those years, if the preference shares are cumulative in nature, in those years where there is no profit, their claim will accumulate year after year. It helps to maintain status quo in the control of the company. If a company issues preference share, then its control will not be hampered. The control of the equity shareholders will not be diluted. The preference shareholders have a right to share the surplus profit in case of participating preference shares. Next, the preference shareholders, there is no legal binding on the form of company, on the part of company to pay dividend to preference shareholder. At the time of loss, the company may provide dividend to preference shareholders or may not provide dividend. The preference shareholders cannot claim dividend. They cannot go for legal proceedings if preference dividend is not paid. What are the disadvantages of issuing preference shares? First, preference shares do not have voting right. They are owners of the company but do not have any say in the management of the company. They only take fixed rate of dividend. Even if there is higher profit, they will not claim anything else. Next, the cumulative preference shareholders become a burden for company because their claim to get back dividend accumulates year after year. Next, if a company earns return less than cost of preference share, then its EPS will come down. What is EPS? Earning per share. That means the company, if a company issues preference share, it is bound to earn a return more than the cost of the preference shares. Next, for purpose of tax calculations and dividends, preference share is not a tax deductible item because preference dividend is not a expense. It's an appropriation of profit. Next, we will discuss third source of long-term finance, that is debenture. What is debenture? We will discuss. We know that debentures, suppose a company wants a loan of 3,000 crores. What it can do? It can classify or segregate the loans into smaller and smaller parts. Each such part is known as a debenture or a bond. The debenture or bond holders are the creditors of the company. Debenture is a part of loan capital of the company. The debenture holders is an instrument for raising debt finance or loan finance. If a company wants loan finance, it can classify the loan into, segregate the loan into smaller and smaller part and sell it in the market in form of debentures. Next, the debenture holders take interest for their investments. Generally, debentures are backed by mortgage or charges. They are given the mortgage of charges in form of immovable properties of the companies. Okay. Now we'll discuss different advantages and disadvantages of debentures. First, debenture is a long-term source of finance. Its maturity period is more than 10, 15, 20 years. The debenture holders are the creditors of the company. The debenture holders are to take a fixed rate of interest. They take rate of interest on debenture is fixed, and cost of debenture is normally lower than cost of preference share or cost of equity share. In case of liquidation of the company, first debenture holders take back their money. If anything remains, then preference shareholder takes, and at last equity shareholders take the money. Then disadvantages. What are the disadvantages of debentures? First, debentures interest is a permanent burden on the company. The company has to pay debenture interest though it does not earn any profit. Whether you earn profit or not, you have to pay debenture interest. Next, we are discussing the debentures are given mortgage. Once the assets of the company are mortgaged to debenture holders, it will be very difficult to raise further finance by mortgaging it the assets further, because they are already been mortgaged under when you issue debenture holders. Then debenture holders can initiate legal proceedings against the company if the company does not pay their principal in due time. Next one is a retained earning. What is retained earning? So we are discussing retained earning. Retained earning means plowing back of profit. Instead of paying back the profit to the owners, the organization may retain the profit and reinvest the profit in the business. That is known as plowing back of profit or reinvesting the profit in the business. That is known as retained earning. That is one important source of finance. What are the advantages if a company use retained earning as a source of finance? It is the cost of fund is low in this case because it does not involve any flotation cost. Cost of retained earning is usually less than cost of equity because equity cost includes flotation cost, but retained earning cost does not include flotation cost. If a company use retained earning, it is not under any obligation to pay any dividend because retained earning is the self-generated fund. There is no compulsion to pay dividend if you use retained earning as a source of fund. Next, as the fund is internally generated, there is greater degree of freedom and flexibility of using retained earning as a source of fund. What are the disadvantages? If a company use retained earning more, there is a possibility of it becoming a monopolistic attitude. It will develop a monopolistic attitude. Next, if the company use more and more retained earning, there is a chance of overcapitalization. What is overcapitalization? Overcapitalization means the company is having capital more than what is required. That is known as overcapitalization. So these are the most important disadvantages of retained earning. Next, we will discuss another source of long-term finance that is known as venture capital. What is venture capital? There are many businesses which are very high risk business, or those are a person has a novel idea but it is not yet tested. It is not yet tested commercially. You develop a new product. The product is very new, innovative. It is not there in the market and you want to produce it and sell it. There is chance that the product will click or there is chance that the product will fail. There is no history of the product. This type of product financing, generally banks and other instruments do not support this type of business. This type of business is supported by different venture capitalists. The venture capitalists are those entities or organization or person who generally invest in new company which set up to commercialize a novel idea. They generally invest in high risk project. They know that if they will invest in 10 project, 9 will fail, but the one which will be successful, the profit generated in that project will be sufficient enough to cover the loss which the person has made, which the venture capitalist has made in other 9 projects. Hence, venture capital investment is a hand-on investment in a high risk project. Those business where risk is high, no other financing institutions are eagering to finance those business will be financed by venture capitalists. So generally the venture capitalist finance in form of equity capital. They not only invest funds in the business, they also provide advisory services to venture capitalists. They provide advice how the business will be formed. Next source of long-term finance is leasing. What is leasing? Leasing is an alternative method of financing. In case of leasing, what you do? You acquire an asset, but you do not pay for that asset. You take that asset on lease basis. Let's take an example. Many airlines business are there. Jet Airways. It take planes on lease basis. That means it use the plane but does not pay for the price of the plane. Instead of that, it pay lease rental to the lessor who give the asset. So in a lease agreement, there are two parties. One is lessor, another is lessee. The lessee takes the exclusive right to use the asset for an agreed period from the lessor in form of lease rents. So with the help of lease, you can take back you can acquire different capital assets like land, building, equipment, machinery, vehicles required for establishing the business on rent basis or on lease basis. The asset will be in possession of the lessee, but in the name of the lessor. The ownership lies with lessor, but the lessee has a right to use the asset. But lessee has to pay lease rental to the lessor. It is a way of financing different assets of the business. In this case, the finance is provided by the lessor to the lessee. So what are the advantages? If the assets are required for a short period of time, it is better not to acquire the asset but to take the asset on lease basis. If the assets you acquire are obsolete in nature, are the chance of getting obsolescence in those assets is very high. Technological innovation in those assets are high. In that case, you should take the asset on lease basis. Next, what are the disadvantages of using lease? First, you have to pay rent. That is lease rental you have to pay year after year till the year you acquire and use the assets. Next, the goods must be returned to lessor in the same form after the lease period is over. You cannot be owner of the asset for the entire period of the assets. Let's take an example. An asset will go for 100 years. You cannot acquire it for 100 years. You can acquire it for 99 years, but after the end of 99 years, you have to return it to the lessor. Then the lessor, after handing possession of the leased asset, remains the owner. Though you use the asset for 99 years, you cannot become the owner of the asset. The owner will always be the lessor. Then after the lease period is over, the lessee will not get the ownership of the asset. The asset has to be returned back to the lessor. Next, another way of getting long-term finance is hire purchase. What is hire purchase? Hire purchase, in case of hire purchase, you acquire an asset but pay for it in installments. So in this case of hire purchase, you acquire an assets of 100 crores, but you have to pay a down payment of 20 crores. Rest 80 crores you have to pay in installments. That means in this way, for the rest 80 crores, you get the asset financed by the hire seller. In this case, the hire vendor provides finance to you by selling the goods in installments. Hence, hire purchase is another method of acquiring capital asset for use without paying for it immediately. Here, the payment are made in installments. Okay, so these are different sources of long-term finance. Next, we will discuss what are different sources of short-term finance. We discussed if you require funds for 5 years, 10 years, 15 years, you go for long-term source of finance. But if you require the funds for, let's take an example, 1 month, 2 months, 3 months, 4 months, 5 months, less than 1 year, you have to approach different short-term source of finance. So today we will discuss what are different short-term source of finance. The first important short-term source of finance is trade credit. What is trade credit? Generally, we know that in business, we purchase goods on credit. Goods and services, if you are practically in a business, you generally buy the goods on credit. You take 3-month credit or 2-month credit and you sell the goods to debtors on 1-month credit and you collect the funds, you make payment to the creditors. That means if you operate a business, some portion of finance is paid by creditors or suppliers to you in form of providing or selling goods to you on credit. That is known as trade credit. Trade credit is a natural source of finance, a spontaneous source of finance to many organizations. Many organizations use this trade credit. So trade credit, there are many advantages of using trade credit because it is naturally available. There is less procedural formalities for obtaining trade credits. Okay. Next, what are the disadvantages of trade credits? The main disadvantages of trade credit means if you use more and more trade credit, there is chance that you indulge in over trading. Next, we are discussing next source of short-term finance, that is known as commercial paper. What is commercial paper? Generally, high-rated companies, if they want money for 2 months, 3 months, 5 months, then what they will do? They will issue commercial papers in the market. So commercial papers are issued by companies having good credit rating. And the company will issue commercial paper for a duration less than a year. And these commercial papers are generally issued at a discount to face value. People buy the commercial papers in money markets, and those commercial papers are in form of unsecured notes. But there is a advantages with commercial paper. These are negotiable in nature. If you want to sell it, you can sell these commercial papers to anybody else. That is, they have a secondary market for commercial papers. Okay, but the most important demerits of commercial papers is it is issued only by high rated companies, high quality companies. Small and medium companies cannot issue commercial paper. If they will issue commercial paper, they have to fulfill different conditions, and there is lack of trust in them, so nobody will buy the commercial paper issued by small and medium companies. Only high rated big companies issue commercial paper to raise short-term money. Next one is factoring. What is factoring? Factoring is a form of selling the receivables. What is receivables? Receivables means debtors. A company have different debtors. Let's take an example. If a company has, these are different debtors of the company. What the company will do? Company has sold this person goods on credit. He has to receive from A 10,000, from B 8,000, from C 10,000, from D 9,000, from E 18,000. He will pack all these debtors and sell these back to a financial institution at a discount. Total is, let's take an example, 27,000. And he will sell it at, let's take an example, 22,000. That means he will approach a bank and he will tell that you take all these 5 debtors and give me 22,000. And you collect the money from these debtors and maintain their accounts also. This is known as factoring. So factoring is a way of liquidating the receivables or debtors of the company. The person to whom you sell the debtors is known as factor or factoring agency. Generally, outside India, factoring is a common practice. Factoring means outright sale of the receivables of a firm to another firm which has specialization in management of trade credit, that is known as factor. But in India, factoring is not so popular because people are not interested to pay the money to somebody else who has not given them money in India. But outside India, factoring is a common practice. There are two types of factoring. One is non-recourse factoring, another is recourse factoring. In case of non-recourse factoring, what happens? The risk of bad debt is taken by the factor. But in case of recourse factoring, the risk of bad debt is not transferable to factor. That means if there is bad debt, you have to bear the risk in case of recourse factoring. But in case of non-recourse factoring, the factor bears the risk of bad debt. So what are the advantages of factoring? Advantages means you get prepayment from receivables, though the amount is 80 to 90% of the invoice value, but you receive it immediately by selling the receivables or debtors to the factor. It reduces administrative cost, time of managing debtors. If in case of non-resource factoring, the risk of bad debt is beared by the factor. This is known as factoring merits. And what are the demerits of factoring? In case of developing country like India, the image of the company is suffered if they use factoring services. It is not so popular in case of countries like India. Next, public deposit. This is another way of getting short-term money. What is public deposit? You know that if a person has some surplus money, he can deposit it with a bank. With bank, we deposit the money for 2 months, 3 months, 4 months, 5 months in form of FD, fixed deposit. And if this FD is done not with a bank but with a company, that is known as public deposit. High rated companies call public deposits money from public in form of fixed deposit for a particular period, that is known as public deposit. Why the people will invest, not invest in SBI but invest in Reliance? Because Reliance will provide a higher rate of interest to the investors of public deposit. So public deposit is a form of deposit, corporate deposit, which is negotiable in nature. That means if you invest in public deposit and if you want to get back the money, you can sell the public deposit in the market, in the money market. Okay, so it is another form of getting short-term finance. Then there is another way of getting short-term finance or long-term finance or short-term finance, that is financing through financial institutions. In India, there are many financial institutions which provide loans. The loans may be long-term loan, medium-term loan, or short-term loan. The long-term loans are generally provided by developmental banks like IFCI, IDBI, ICICI, and these developmental banks provide loans for 10 year, 20 year, 25 years more, like this. If you want long-term finance, you have to approach a developmental bank. There are the medium-term loans and short-term loans are generally provided by commercial banks. Other financial institutions are there. Insurance companies also provide long-term loans. Similarly, different NBFCs also provide medium to long-term loans. NBFC means non-banking finance corporations. So the loans can be obtained in form of term loan. We have discussed term loan means loan for a particular term, that is known as term loan. The loans can be obtained in form of term loan. Next, loans can be obtained in form of bank credit. What is bank credit? Banks providing credit facility. The credit facility is provided by a commercial bank, that is known as bank credit. The bank credit may be in different forms. First form is overdraft. What is overdraft? Overdraft is a facility which is provided to the current account holders of the banks. The banks, in this case, in case overdraft facility, the current account holder is permitted to withdraw more money what they have deposited. That is known as overdraft facility. The overdraft, the banks provide overdraft facility to only to current account holders. But there is a limit of overdraft. That limit is known as OD limit or overdraft limit. Next one is cash credit. It's another way of providing bank credit. Cash credit is the major portion of bank credit in India. It is popularly known as CC, cash credit. In case of CC, generally banks provide loan against stock of the organization. If you have a in case of CC limit, there is a limit for CC. What the organization does, what the companies does, they prepare their working capital requirement for the next month and give this statement to the bank. On the basis of their requirement, banks provide CC or cash credit to different corporates. So cash credit is another way of getting bank credit. And banks also provide loan facility to different organizations, companies. The companies can take loans in form of bank credit. Another is bill discounting. What is bill discounting? This is another way of getting finance in form of bill. Generally, when you sell the goods on credit, you generally raise a bill against the person to whom you have sold goods on credit. Then this particular instrument is known as bills of exchange. You draw a bills of exchange on the debtors. The debtors once accept the bills of exchange, it becomes a negotiable instrument. And the bill can be discounted with the banks. If the bills are discounted with the banks keep the bill and make payment by deducting some amount. If the bill amount is 20 lakhs and you raise a bills of exchange, and bank will keep the 20 lakhs bill and pay you, let's take an example, 19 lakh 50,000, and 50,000 is the discount. This is the cost of finance of bills of exchange. Okay, next, another way of getting finance is LC. What is LC? Letter of credit. Letter of credit is a written undertaking by a bank on behalf of its customer. That means if you will not pay to the person who sold the goods, bank will pay on your behalf. That is known as LC, letter of credit. In case of import-export business, where the buyers and sellers are not known to each other, LC play an important role. Next, we will discuss different emerging sources of finance. New sources of finance, innovative sources of finance, that is known as emerging sources of finance. The most important emerging sources of finance are asset securitization. What is asset securitization? In case of asset securitization, what the banks generally follow this method of financing, the banks collect different loans which they have provided and they transfer the loan to a SPV, special purpose vehicle. Then the SPV convert the loan into different securities and they sell the securities in the market, and the person who buy the securities, they ultimately own the asset. That type of arrangement is known as securitization. In case of securitization, what is created? Some asset backed securities or mortgage backed securities are created. With the help of securitization, banks generally clean their balance sheet. So banks give loan, banks pull the loans, then transfer the loan to a SPV. The SPV convert the loan into different securities. The SPV sell the securities to different persons, and the persons ultimately own those loans. That arrangement is known as asset securitization. Next one is angel financing. What is angel financing? Angel financing is known as startup financing. Nowadays, there are many angel investors who generally invest in new startups. They invest in those business where the promoter has a passion to do something new, and that type of financing is known as angel investment. Next one is crowdfunding. What is crowdfunding? In case of crowdfunding, the fund is arranged with the help of social networks in form of different donations. People donate for a new or innovative business. The promoter advertise his idea, his business in social media and invite donations from the people. People who donate to the business generally are provided certain rewards by the company if the business or venture is successful. So it's a reward based financing that is known as reward crowdfunding. Crowdfunding is a reward based financing. Another is small business credit cards. Like, what is small business credit cards? Like, you take the credit cards, business can also have credit cards in its name. That is known as small business credit cards. With the help of small business credit cards, business may require funds, get back funds when it needs. So in our today's class, we have discussed different sources of funds. Okay, we have discussed different sources of funds. Then we have discussed how the sources of funds can be obtained from short-term sources and long-term sources of funds. Then we have discussed how venture capital financing is used for high-risk projects. At last, we have discussed different innovative source of financing like angel funding, like crowdfunding. We have discussed all these things. So the important questions involved in today's discussions are: first, we will discuss critically examine equity capital as a source of finance. As a manager of a company, if you need funds, how you will use different source of finance? Important question is: what are the advantages and disadvantages of using debenture as a source of finance? How lease finance is obtained, and what is asset securitization, and what are the methods of using asset securitization as a source of finance, and different projects where venture capitalists invest their funds. With this, I conclude my session today. Thank you. Thank you for watching the class. Thank you.